Hello, traders. It is Sunday, March 29th, and I'm sitting at home on lockdown just like everybody else. I'm doing some market research. I've been going through a lot of the comments that have been sent to me over the course of the week. And one thing that seems to be coming up is, hey, Pete, I'm an investor. I'm not a day trader. I'm not a swing trader. I'm an investor. And I really like what you're doing with the bullish put spreads and selling naked out of the money puts, but I've heard that's the riskiest strategy you can do. In fact, it has level 4 approval required by my brokerage firm. So I'm a little nervous about doing all this. What you do and how you explain it kind of makes sense, but I'm afraid to dip my toe in the water. So I'd like to do a little bit of analysis. I'd like to tell you a little bit about the strategy and how it works. And I'm going to find a stock. I'm going to show you a stock that presents an excellent opportunity for us to do that. And I'm going to use Option Stalker to find it. So everything will be geared around that one trade. So let's take a look at the market first. And we've got this dramatic sell-off, and we had the bounce this week, which, by the way, I think that we've got 2 more weeks of very, very heavy news. So are we going to go back and test the low? We could. Very well could. This is going to be a bottoming process. For those of you who think this is it, buy calls, market's going to shoot higher, V bottom. I don't think so, and I'm certainly not playing it like that. Option implied volatilities are extraordinarily high, so we have to take advantage of the high IVs, and we need to be premium sellers, not premium buyers. Plus, even if the market is up one day, what are the chances of getting another one and another one? That type of follow through? Well, if we couldn't react to a $2 trillion stimulus package and be off to the races, we've even had the promise of a $4 trillion stimulus package. Hasn't done anything. So, right now, it's all about the virus. It's all about the spread of the virus slowing. That's going to take about another 2 weeks or so, according to all the data points that we have from other countries. So, be ready for some more bad news. That's okay because we're going to take advantage of these high option implied volatilities. So, naked puts. First, let me dispel the fact that this is a super, super risky strategy. If you're familiar with covered call buying, naked put writing actually has an equivalent risk reward ratio, and I'll show you how that works. Is it a really, really risky strategy? Well, it depends. If you were selling naked puts up here with the market that high, with option implied volatilities very low, then you are not properly being rewarded because look at how tiny those option premiums were, near historic lows. Plus, you had the market near all-time highs, in fact, at all-time highs. So, yes, your risk of selling naked puts would be much greater up here than it is down here. But you would have the same risk if you were buying stock and selling calls as you would have if you were selling naked puts. Well, how can that be? Because you are long the stock and you've sold some out of the money calls or at the money calls. Well, those calls gave you very, very limited protection. And now you're just outright long the stock. So you're taking point for point risk with that underlying stock. So for every naked put right that I show you, there is an equivalent covered call position that you could take with the underlying stock. So know that, and I'll show you how the whole strategy works and the types of analysis that you might be wanting to do. So for longer term investors, you do need to incorporate more fundamental research in your trade. Now, I'm pretty pure technician because my time horizon is a day or maybe a few days, maybe a few weeks if I really have the right market conditions. That doesn't mean that I'm foreign to fundamental analysis. I understand completely how to do fundamental analysis. And the trade that I'm going to show you does have some fundamentals incorporated into it. So bear with me. We're going to take a look and we're going to find a stock right now. And the underlying assumption is that the next 2 weeks in the market are going to be pretty dire. We can expect more bad news. We can expect the market to come back. We're looking for a decent return. Well, what would a decent return be? With interest rates at 0% right now, you can't make anything investing in bonds. In fact, bonds are producing a negative real rate of return because they don't even keep up with inflation. So you will lose money in bonds consistently. Well, if I can generate somewhere around a 10% return over the course of the next 3 months, would that be a decent rate of return? Yeah, I would sure think so. 10% over the course of 3 months. If I can do that 4 times a year, I'm at a 40% return. Sure. Well, what kind of risk am I going to have to take to generate that kind of return? Because I'm pretty passive and I'm not into taking a whole lot of risk right now. Okay, great. Well, let's find an opportunity then. So what I'm going to do is I'm going to bring up the custom search engine, and there it is. You know that I like relative strength, so I'm going to be looking for strength on the S&P 500 on a daily basis, especially if I'm looking for a swing trade or an investment. I've got to have some relative strength. I'm not going to trade without it. I'd also like to have our proprietary trade signal on a buy signal, at least on a daily, 4 hour and 2 hour basis. I might even be able to go to a 1 hour basis, but we'll see what kind of stocks return in this search result. I do want to have liquid options because I plan on trading options. So we'll just put a value of 0. Usually I like having a value of about 3 or so, but we gauge option liquidity based on bid-ask spread. That's one of the many components that we use to calculate our option liquidity rating, and the bid-ask spreads have really widened out. So they're all going to be lower ratings than we're typically used to seeing. That's why I'm using a value of 0. And we can take a look and see what comes up in this search. Not that many candidates. I've got another criteria that I can use that I do like to use. It's my momentum booster. Typically, you would want to have a stock that has positive momentum, but if you have all of these stocks showing up and it actually is negative, that is like a super catalyst. So I'm just going to add it to see what that does. Oh yeah, that dramatically reduces the number of search results that are coming in. So these would all be good candidates. And I know that I see one in here because I ran the search early and I prepared for this presentation. So this is how I found it though. And I actually went to the other search first to see these candidates, and these were all, there were some really nice candidates in here too. So not going to go through all of that right now. I just want to show you the one that I found, and I want to talk about the strategy and focus on naked put writing. So first of all, your broker does have to approve you for this. It is considered by the exchanges to be the riskiest form of option trading. So they're going to be looking for lots of experience and solid financials. So if you don't have that criteria, you're probably not going to be able to do naked put writing. So let's take a look at these stocks right here. And one that you'll notice on the list is VLO. And that's the one that we're going to be focused on. And you can see how the stock had been gradually drifting lower, and then when coronavirus hit, it caved in. So who is VLO and what do they do? They are the largest refinery in the United States. So they make gasoline products. Well, gee, Pete, why would we want to own that? Oil prices are tanking. Nobody's driving. The streets are empty. The parking lots are empty. Economies around the world have been shut down, so the demand for oil is very, very low. Yeah, this is not a particularly good time for oil producers, not a particularly good time for refiners, but refiners are really in a different space. What they do is they buy that oil, and that's a large input cost for them. Well, they're able to buy that oil very, very cheaply. And all they're really interested in is that spread margin between the refined product and the price of oil, and that becomes their profit margin. So, for my own perspective, as soon as the world starts to get back on its feet, the demand for gasoline is going to be right back up again, even for jet fuel and airplanes. Will it take a little while to recover? Yes, it will. Well, what's one of the advantages to owning refiners? Well, I'll show you one right now. It's called NIMBY, and that stands for Not in My Backyard. Well, what's so great about that? It means that there haven't been any refiners built in many, many years. You can see that there was a refinery built in 2018, only 35,000 barrels. 2016, 42,000 barrels. Some of the biggest refineries are 100,000, 150,000, even 200,000 barrels of output. So you can see that over the course of the last 20, 30, 40 years even, there have not been many refineries built. So what that does is if you've got a refinery up and running, you've got maintenance costs that you have to put into it, but you've pretty much got a monopoly because nobody wants these refineries built anywhere. And it's much cheaper to refine products here in the US and then to distribute them nationally than it is to buy the refined products from overseas and have them shipped here. So Valero does it domestically. I'm sure they've got some off-seas refineries, overseas refineries as well, but the demand for gasoline is going to return. It's just a matter of time, and then they will be able to make that margin over and over and over again. So you could argue that right now they're going to have a really decent profit margin because you've got oil prices coming in, so their input price is very, very low. But the demand for gasoline is not real high now. But it will resume and it will be good again very, very quickly. So let's take a look at what the financials look like on Valero. And we're going to go into the stock ER. And here you can see they've got cash per share of $6, but debt of $26. So these refineries require an enormous amount of capital. They're huge, huge investments. So the fact that they've got some decent cash on hand is good. They're able to sustain this short-term shutdown and they'll be able to get back on track. This is a strategic company. This is even defensively significant for the country. So when it comes to bailout money, you can bet that the government is going to want to make sure that the refineries are able to keep up and running. So that's one thing that it has working for it. You can take a look and see that the forward PE ratio right now is $5.40 or excuse me 5.45, which is very, very cheap. And we'll take a look at that chart again. Now, great. The stock looks decent here at $45. But that's not where we're going to end this story. They do also pay a dividend, which is very important to the strategy that I'm going to be showing you. So the dividend was just recently paid, and I'm going to show you this. You can see the dividend history. They recently paid 98 cents. They're somewhere in the 90-cent category. So it was just recently paid about a week ago, 2 weeks ago or so. So we're going to be able to get through the next quarter without having a dividend payment. And this is only significant when you're comparing what do I get when I do a covered call position where I own the stock and I've sold a call against it versus selling a naked put. Well, if I'm buying the stock and I'm selling a call against it because I'm the owner of the stock, I get to collect that dividend. Well, in this case, it's a 90-cent dividend. That is significant, especially when you're looking at a stock that's trading at $45. So it's got a really nice dividend yield of almost 9%, making it very attractive right here, right now. I mean, you could just sit on the stock all year and make a 9% dividend. That's not too bad. But Pete, I'm worried about the market. I'm worried about the demand for oil. What if this goes on for 6 months? There won't be any demand for gasoline then either. And I just don't want to take that kind of risk. Okay, I understand. You want to play it safe? That's fine. We're going to look at selling a naked put out of the money. Okay, well, where has the stock been? It's been down to $32. Would I buy it at $32? Well, with the stock at $45, yeah, sure, that'd be a good price at $32. What if I wanted to buy it for 50% off? And I said, listen, enough's enough. If you cut this stock in half again, it was at $100 before any of this coronavirus stuff. If I could buy that stock for $20, would I do it? You betcha I would. Okay, let's take a look at that trade. And then I'll show you what the equivalent trade would be if we did a covered call rate on it. So I'm going to go out to June. We'll go regular expiration, and we're going to go down to the $20 put. And here you can see that that put option is bid at 39 cents and it's offered at 83 cents. So might I be able to split that bid ask spread? Yes, I think you can. In fact, I think you could get at least 50 cents for that. maybe even 60 cents if you got a little bit of a pullback in the stock. So let's say that we can get 60 cents on this particular put that we're selling. So our net cost on the stock would not be 20, it'd be $20 minus 60, which would be $19.40. And if I wanted to do this as an investor, okay, so I'm talking about doing it as an investment, then what I would want to do is I would want to have half of that strike price, half of 20 is $10. I would want to have half of that strike price in cash so that if the worst case scenario happened and I got assigned the stock at $20, I would have plenty of cash to buy the stock outright using Reg T. Okay? Reg T means that I have 50% margin that I can put up. That means that I need to put up $10 for this trade. And let's keep the math fairly simple here. Let's say that we're going to generate 50 cents on this trade, which I know we can get more than 50 cents for that. That would be a 5% return on investment. A 5% return on investment. If I wait for 3 months, and that would allow me to buy the stock at $19.40 if I am assigned. If I don't get assigned, I get to keep my 5% consolation prize. There are 4 quarters in a year. That would be a really nice 20% return on investment. This might all sound crazy, but these numbers are out there, and they're out there because option implied volatilities, uncertainty is out there, and these are the types of returns that you can enjoy on an investment basis. Well, gosh, I'm looking for something a little bit more than that. I'd like to make a little more money than that. Well, then you can leverage this position, and you can leverage it. You need to put up 20% of the strike price. Now, there is relief that you get out of the money. You get to subtract the out of the money difference down to a minimum of blah, blah, blah. I'm going to keep this easy. If you put up 20% of the strike price, you're going to be fine on this until it gets in the money. But I don't think it's ever going to get close to being in the money. So if I've got to put up 20% on this, that means that I would have to put up $4 in margin. Okay? So if I put up $4 in margin for this particular trade and I'm able to bring in 50 cents, that's going to be somewhere in the neighborhood of a 12.5% return in 3 months. That is a very nice return. And that's what we're going to be looking at. If I wanted to do a covered call position, then I could also construct something very, very similar. So for a covered call position, what I'd need to do is I would buy the stock and I'd be paying $45 for it, and I'd be selling this $20 call right here. So in that scenario, I'd have the same position on, but I'd have a chance to also make the dividend, which the dividend has already been paid out, so we don't have that coming in. But I would be selling this call, and you can see the stock's at $45, so I would need to sell this call for $25, but actually I'd want to sell it for $25.50, and I should be able to sell it for more than parity. The intrinsic value of that call is $25. Okay, that's what it's actually worth right now. Well, given that there's 3 months of life to it, I better be able to bring some premium in on it, and so I would be able to sell that option for at least $25.50, and you would have your same exact position as if you were selling naked puts at $20. Same profile. So long stock, short call is an equivalent position to a naked put as long as you're using the same strike price, which in this case is $20. So when I buy the stock and sell the call, I can also do that on Reg T margin. Okay, so I can buy the stock, put up 50% of the stock price, and I can sell this call and have exactly an equivalent position to what I showed you earlier. But the advantage to selling the naked put is that you don't have to put up as much margin. You don't have to put up 50% of the strike price. Stock price. You only have to put up 20% of the short strike. So, in the course of 3 months, you'd be able to generate a 12.5% return on this trade. That is a 50% return annualized. Sticking your toe in the water, really smart idea right now. If you believe everything that I just told you, the fact that gasoline demand is going to start coming back in another 3 months, the fact that the oil refineries are pumping out oil and the input cost for refiners is going to be really low right now, they'll be able to make a nice profit margin on it, and that eventually the economy is going to come back, and that the demand for gasoline is going to come back. And that if by chance something really freaky happened and you were able to buy this stock at $20, that you would be willing to do that. If those are all true, this is a great investment for you to make. Not a great trade, a great investment. If you want to be a little bit more speculative about it, then you can sell this naked put and you can generate a really nice return. So the difference would be sell this and put up half the strike price, then you'd be making a 5% return. Put up 20% of the strike price, then you're going to be making a 12.5% return. So that's how it works. And yes, there are a ton of these trades out there, but they won't last long. Well, why do you say that? You just told me, Pete, that the market's going to start finding support. And we've seen the market find support, right? But there's going to be some ugly news coming out for the next week. And I can expect the market to maybe even go back and test the low. Yeah, I think that's definitely possible. But in this small little bounce higher that the SPY has done, let's take a look at what option implied volatilities have done. Crush Ola. They've gone from $76 down to about $50 on the VXX, which measures option implied volatility. That is a huge drop. So even if the market sells off hard this week on really, really ugly news, and let's say that we test the low that we put in a week ago, I think at best the VXX gets up to maybe 60, 64, probably not, but let's say it does. You can see how every aftershock that we have in the market, the VIX makes lower highs and the trend will start coming in. And if you think about it, the market has to keep going down at this pace for the VXX to keep going up. Well, if it just comes down here and pauses and spends some time in this area, option implied volatilities are going to come in. And think about VLO. Look at that stock. Do you think VLO, a refiner, is going to drop down to $20? Given that there aren't any new refineries that have been built, given that that monopoly that they have has been great for profit margins, there aren't going to be any new refineries built in the United States. Nobody wants them. Not in my backyard. These guys have a printing press over a long period of time. They've got maintenance costs that they have to put in, and as the price of oil varies, yes, their profit margins start to vary. But apart from that, these guys are in a really, really nice business. So that's another reason that I like it. And that's what makes this fundamentally sound on a longer term basis. When you add in the huge option implied volatilities that are out there, it makes this an even better situation. Well, gee, Pete, the way you make it sound, I think I could get more aggressive with this, and I don't think I've got to go down to the $20 strike price. I think I could go maybe down to $30. I could really pull in some nice money. That's fine. No problem. Then you're getting a little bit more speculative, and the intent for the video was to show you how, as an investor, you could start dipping your toe in the water and taking advantage of option trading strategies and this high option implied volatility, and how you'd be able to use Option Stalker to find stocks that might fit that criteria. It's a really nice search. I like using the buy signal across multiple time frames. I also like using relative strength on SPY across multiple time frames. Make sure that you've got some decent option liquidity in there. Those are really all you need. Then you start clicking through the search results at the different companies that are out there. You are going to find some unbelievable value. I may do another video tonight. I'm not sure. I got to see how the overseas action is. I'm looking for some weak heavy news this week that pushes the market back down again. So we'll see if that plays out. If it does, I'm going to keep selling these naked puts. And in the last few weeks, we've done Google. That was beautiful, down at the $650 strike price. And those will expire April 17th. Yes, I like that trade. Twitter, I think we were down to the $17 strike price. Yes, I think that would be an excellent buying opportunity on Twitter. That trade is working out beautifully after 2 weeks. Cisco was another one. Oh, yes, that stock has been moving higher. That one, I think we're selling puts below the $30 strike price. Facebook was another one. That one we sold puts at the $100 strike price. Look, that would be a 33% decline from current price levels. Even if the market makes a new low, yeah, Facebook may revisit $140. It's not going down to $100. I'm pretty dang confident of that. And I just posted another video yesterday that had some really nice picks in it. That was from my weekly swing trading video that I published on Tuesday night. And I published that Tuesday night because I suspected that we might see a market bounce this week, and I did not want to miss the opportunity. Sure enough, Wednesday morning, we opened on a weak note, and we were able to get these naked put rights off. So happy with those trades. CRUS was one. Nice. ITT, SQ. We didn't get that one off. That one I could tell that it had relative strength. The next morning, boom, shot higher. Never had a chance at it. But I could tell based on the price action and all the different metrics that we use in custom search that that was going to be a good one. That's why I highlighted it. SWKS, beautiful. Yelp, beautiful. These all have incredible fundamentals. Go into stock ER, you can see how much cash they have per share and what the PE ratios are, what the businesses are, their growth rates, the fundamental ratings on everything. SWKS, really nice one too. Look at that, $7 in cash per share. Really easy, just go into stock ER. I've got all the metrics. I designed Option Stalker during the financial crash of 2009. So yeah, I'm a technical trader. I've got all the fundamental information that I need to make a good decision on the investment side. So whether you're an investor or a day trader, we've got you covered. Hope you enjoyed this video. Please give it a thumbs up if you like the content, and make sure to subscribe to the YouTube channel and turn on your notifications. Then you'll never miss another one of these trades. I think VLO sets up beautifully for a nice longer term investment. Hope it works out for you. Thank you. Have a good weekend. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.